Valens Research, Uniform Financial Analytics.
So you can see here as Microsoft loads, it initially loads and you can see we've got this chart. This chart is what we call the performance and valuation prime chart. We call it that because it highlights a company's performance, ROA and asset growth, and it highlights the valuation the market is paying for a company. And then we also highlight how the company's performed. Now looking here, what's really important is if we look, you see these orange bars, and you can also see these blue bars. The orange bars are the distorted as reported accounting metrics for this company from Microsoft. While the blue bars are what the actual returns are of a business once we make the uniform accounting adjustments that we make to remove the accounting noise. We show you first and foremost the ROA of the company, the returns of a company. And so you're seeing historically for the last 15 years, we're showing you what is the return of Microsoft before we make our uniform accounting adjustments and after we remove the accounting distortions and make our uniform accounting adjustments. We also show you asset growth, similarly, where we show you the as reported versus uniform accounting asset growth. The reason why we show these two charts together is because these two charts together are actually an incredibly powerful way for us to understand the cash flows a business generates. We actually have an article in our Institute of Strategy and Valuation, and it's a great teaching point that we talk about. There are times that free cash flow is a positive free cash flow is a good thing. There are times when positive free cash flow is actually a sell signal for a company. And there are times that negative free cash flow is actually one of the best buy signals you can see for a company. And it really revolves around breaking that free cash flow up into the returns of a business and the asset growth. If you think about it from a DCF perspective or a free cash flow perspective, an ROA for a company is really representing what is the operating cash flow this company is throwing off. For Microsoft, for every dollar you invest in Microsoft, you get 34 cents back a year, which is actually a pretty impressive return. The average company in the US right now generates about a 12% return. So Microsoft has a, 34% return for Microsoft. So Microsoft has a 34% return, which is almost 3 times higher than what the corporate average return is right now. But then the other side of the question when you talk about free cash flow is you have cash flow in, which is your cash flow from operations, and then you have the cash flow out, the company's investment in the business, right? Think CapEx. Well, for us, we don't just look at CapEx, we look at the total investment a company's making into the business. But if we look at Microsoft here, if Microsoft had an asset base of $100, they would be throwing off $34 in cash flow, and they'd be putting 13 of that, $12.70, back into the business. They're reinvesting that in terms of asset growth. So that says that this company has, right, free cash flow of roughly $21, adjusted free cash flow of $21 in 2019. And we can see that historically, and it's really powerful because all of a sudden, once you visualize it, it's easier to understand what's going on. We also look at, right here, these two light blue bars and this light blue bar here are what sell-side analysts are forecasting returns and growth for the company to be for the next 2 years when we take consensus sell-side estimates and we put it into the uniform accounting framework. And lastly, these 3 white bars here are what the market is pricing in for Microsoft to do for the next 5 years at $146, the current stock price. Said differently, for Microsoft to be worth $1.1 trillion, they need to continue to have ROAs, basically see ROAs fade from 37% in 2020 to 31% in 2024, and they need to keep growing at about 9% a year, which is about the average that they've grown for the last 5 years. So, and this is the really powerful thing about how you can use uniform accounting and use the Valens Research app. The immediate question that you have is, all right, when I look at Microsoft, now let's understand, do I think that Microsoft's returns are going to fade back to the average levels they were for the last 5 years? Or do I think that Microsoft's returns can continue to rise higher as they shift into Azure and they shift into their, if you will, subscription business, which legacy things like Adobe and others show us has it drives an ROA inflection? Well, if you think that they are going to kind of be their historic normal ROA that they've been for the last 5, 10, 15 years, Microsoft looks fairly valued right now. And guess what? You don't need to do any other analysis. You don't need to do fundamental research to roll up your sleeves because the market doesn't have a divergent view from what you're thinking of a company. But if you now, after understanding what the market is thinking, think, there are reasons that I think that Microsoft could actually potentially drive returns higher, well, all of a sudden you can actually say, okay, now I'm actually going to spend time rolling up my sleeves and doing my own investment research. That's what's so powerful about this chart here. These two charts together help you understand where the companies come from and what the market is pricing in for the company. Because all the great investors, if you talk to Bill Miller, if you talk to Seth Klarman, if you talk to any of the other greats, will all tell you the first thing that you need to do is to understand what the market is telling you the market thinks about a company before you ever come up with a thesis on what you're actually going to have as a view for the company. And that's what we're showing here with Microsoft and every single other company that we have in the database. But it's not just those two charts. We also showed these two charts down here. This is the VA, our enterprise value versus assets, right? Our price to book multiple for enterprise for Microsoft. And we also showed in this blue bar our adjusted PE for Microsoft versus the as reported PE for the Microsoft. The last thing that we show is this TSR relative to the market chart, right? So for those of you who don't know, TSR, the first three letters here, is the total shareholder return a company is generating. That's the dividend paid plus capital appreciation that the stock gave to any investors in the stock over that year. The R in TSRR means relative to the market. So that means if the company performed in line with the market, this line will be flat because the TSR was in line with the TSR for the market. If the TSR rose, like it does here, that actually says that the TSR outperformed the market, and if it fell, that means it underperformed. What's really powerful here is when I actually take this chart and make it larger, what you can see is there's actually a much stronger relationship here between uniform accounting ROA and asset growth versus the as reported metrics that you're seeing whenever you look at a company and the TSRR that we see because the market's paying attention to the uniform accounting data. And why? Because if they did pay attention to the as reported accounting data, they'd be having directionally wrong and completely incoherent thoughts about a company. And just look at it from Microsoft, where you can see as reported ROAs for Microsoft are 10%. In reality, Microsoft is generating a 34% return. If you were looking at as reported metrics, you would think that Microsoft actually had ROAs that were 3 times lower than they really are, 75% lower. Another issue with this is if you look at as reported metrics, you would think that since 2009, ROAs for Microsoft have fallen from 18% to 10%, that they've been basically cut in half. In reality, ROAs have risen from 32% to 34%, while Microsoft has been steadily and healthily growing. If you were looking at as reported accounting data, you would think Microsoft is a declining business that also is trading more expensively and has lower profitability. In reality, Microsoft has been a company with stable returns, cyclical but stable, with stronger returns and also with a lower valuation. So the last question you might have for Microsoft before we go to the next is looking at this and understanding, okay, so now let's say that I actually think that Microsoft is undervalued. Right, if I think that Microsoft is undervalued, what could Microsoft be worth? Like, let's say that I actually think that Microsoft can see ROAs that have risen from 28% to 36% would rise further. We'd say we'll go to 44% going forward. Well, I can open the embedded expectation tool right here, right? And I can type in that scenario. Let's say I leave my asset growth at 9%, and let's solve for stock price. If Microsoft can do that, if they can see ROAs continue to expand as they have, Microsoft has 40% upside. And look at how quickly we can do a scenario like that, and then we can actually ask. Just really quick before we continue, we did just get a question, and for anybody who wants to, you can always enter questions in the Q&A box here that's on the Zoom app. So we got a question from Dallas, and Dallas asked, what are the material distortions that are causing Microsoft to have such a lower as reported ROA? And so with that in mind, I'll actually take you over here. And if we look, what we can go to is the impact of adjustments tab. This tab helps give you a bridge from as reported net income to our adjusted earnings number, and as reported assets to our total adjusted assets. And so you can see, okay, I can actually understand here what's driving ROA to be, the adjusted ROA to be so much better, and what's the distortions that as reported GAAP creates. And we can see here there's a couple of issues. One, as reported accounting causes you to include stock option expense as an operating expense. If you actually think about it, stock option expense is you actually avoiding having to pay a cash expense. And in fact, the other issue with stock option expense, the vast majority of stock option expense does not relate to compensation you gave to management. It relates to you having to mark to market based on Black-Scholes and based on changes in stock price, the compensation you already paid management years ago that's in the process of vesting. It has nothing to do with the operations of a business. So we actually add that back to net income when we get towards our adjusted earnings. On top of that, when we look at Microsoft's taxes are actually slightly understated based on what normal tax rates would be for them because of distortions around NOLs, interest tax shields, and other issues. Another adjustment that we make is we capitalize R&D here under uniform accounting because we understand the idea that that the matching principle, which is one of the first principles that anyone here who's ever been a CPA or taken an accounting class in your university would have learned, which is the idea the matching principle is you should recognize expenses in the same period that you actually recognize the revenue they're related to. If you think about a company like Microsoft, they're developing product for 2, 3, 4 years before they actually send it to market. A pharmaceutical company is investing R&D in a product that they might see revenue on only 11 years from now. And yet we expense R&D, which makes no sense. So what we do here at Valens under uniform accounting is we capitalize the R&D for the life of that R&D, for how long it's likely to benefit the company and their revenue and create value, just like we would PP&E. PP&E gets put on the balance sheet until it's no longer useful. And then we actually amortize it over time. So the difference between Microsoft's investment and the actual, if you will, depreciation of R&D for Microsoft is actually $2 billion. They're investing $2 billion more than they need to maintain the business. So if we just focus on maintenance, we can see this company isn't generating $39 billion of net income. It's generating $42 billion of net income. But just as important, the assets, the operating assets for Microsoft are massively overstated. This is a company with $286 billion of assets on its balance sheet if you were to pull open the balance sheet. In reality, a lot of those assets have nothing to do with the operations of the business. For Microsoft, Microsoft has probably more than $100 billion of cash on their balance sheet. Do we really think that Microsoft needs to have $100 billion of cash on their balance sheet? Just intuitively, if we step back, of course not, right? Most of that they're keeping on their balance sheet because they're choosing to. It has nothing to do with their operations. It's an asset allocation decision. And so if we actually focus on understanding how much of that cash is operating cash, what we do is we look at the R&D investment a company's making, the amount of revenue the company generates, and also we look at the deferred revenue the company has on their balance sheet. We combine all those factors to understand what is the normal amount of operating cash the company needs. Anything that's above that, we take that off the operating balance sheet and we treat it as a non-operating investment when we're actually valuing the business. Also, goodwill intangibles. That has nothing to do with the company's operations. That's all about how a company decided to grow. Did they decide to grow by acquisition or grow organically? If I look at Microsoft versus looking at a company like, say, Adobe that hasn't grown as much through acquisition, and I want to for comparison of how profitable they are, I really shouldn't be looking at goodwill. Similarly, we actually look at net working capital. And then we talked about R&D and why we capitalize it, but that's an asset that should be on the balance sheet if this company is making R&D investments. And so we add that too. And so making all of these adjustments and some others are how we get from a total assets from almost 300 billion to actually 125 billion. And the combination of Microsoft having higher earnings than the market realizes and a smaller operating asset base is what drives us to understand that Microsoft's returns are actually much stronger than people realize. Great question, Dallas.
Valens Research, the world's leading source for uniform financial analytics.